Markets remain at or near all-time highs, but some billionaires are making big bets against stocks. Many hedge fund managers are shifting money into investments like gold.
And George Soros has a massive bet on with put options on the S&P 500. That means the more the index goes down, the more money he'll make. So is this so-called smart money being smart? For that, we turn to our guest this week. Liz Ann Saunders is Chief Investment Strategist at Charles Schwab. And Kevin Kelly is the Chief Investment Officer at Recon Capital. Liz, would you be betting against stocks right now?
No, not longer term, but I think our view has been you want to stay at your long-term strategic allocation, but take advantage of volatility to make tactical moves around that. And I think to the extent you've ridden this rally up and you're now overexposed relative to your target allocation, I would certainly use this as an opportunity to pare back some of those gains.
So do you think institutions are doing that? They're paring back their stock?
If you look at Sentiment Trader has a wonderful index, Smart Money, Dumb Money, and it actually looks at the cohorts of those areas and looks at what these investors are actually doing. It's not an attitudinal measure of sentiment. And the so-called smart money is actually quite pessimistic, so it may include types of investors that you mentioned. And the so-called dumb money, the odd lot, short-term traders, they're much more optimistic. And in the past, when you've seen a wide spread like that, you've had a little bit of trouble in the near term for the market. So I think given that this has been a sentiment-driven rally from the pessimistic lows of Brexit, I think the fact that we're at the opposite end of the spectrum right now in terms of optimism suggests that we might see a bit of a pullback here, but I'm certainly not bearish.
Kevin, let's step back a minute. All of the bearish bets that are being made that have gotten a lot of press this week, these bearish bets were made in the early part of the summer. If you just bought an index fund, you've probably outperformed 95 or maybe 99% of the hedge funds out there. So we're talking about it as smart money, but really the smart money has not been smart at all this entire year, correct?
Well, what's interesting about what's happening is the smart money is doing what it does best, and they're really hedging their portfolios, whether they're starting to get into gold, which is a natural hedge for their portfolio. The news of George Soros, what he was doing is he was actually protecting his portfolio. He started getting into some longer positions like Liberty Broadband, right? So he's even taking long positions that are economically sensitive. So he's doing what he should be doing, and as well as the cost of insurance has gotten cheaper since the start this summer, which is kind of funny. So he can actually put on more of those put options. So basically, investors need to figure out where they want to be, and a lot of the sectors have done well. The leading sectors, look at technology. Technology has performed well, especially this earnings cycle, and the guidance going forward in that sector is doing well, especially with healthcare. So some of the biggest sectors are really pushing this market. We haven't seen financials come in, but they may be the next leg to move the market higher.
Liz Ann, about 2 months ago, we had a Brexit, or at least a vote on the Brexit, and the markets went down dramatically. Did you think they were going to recover this quickly?
We did put notes out at the time saying, hey, this is the opposite of what we just talked about, which is an opportunity maybe to bring exposure back up. But the rapidity with which we saw the improvement, I think, was a bit more swift.
So what do you think this is? Is this a classic liquidity-driven bull market born from and continue to be sustained by interest rate cycle of the Federal Reserve?
I think it's the liquidity component of as it relates to what central banks have been doing globally. But as I mentioned, I think not only this most recent rally, but I think this entire bull market has had a sentiment underpinning to it. This is the classic wall of worry kind of market. When you look at not only the attitudes of investors, which at least on the retail side, which is our bailiwick, the pessimism and skepticism has been pervasive this entire time, you know, Rodney Dangerfield bull market, whatever you want to call it. And that has meant that there's a lot of fuel that sits there. And if there's any kind of catalyst, there is no alternative market.
We have some millennials that watch the show that may not know who Rodney Dangerfield is, and so that's the get no respect sort of market.
I know. Sorry, we're showing our age.
No, that's cool. But Kevin, let me ask you this question about the bull cycle and the liquidity-driven. The Fed is saying, at least the minutes and the discussion from President Bill Dudley, that they're going to start raising rates. Is that why guys like Tepper and Carl Icahn are getting out of the market, reducing their equity exposure?
Yeah, I think a lot of the pessimism is stemming around that we hit peak earnings in 2014. So we're in this sixth quarter now where earnings have actually come down, and we're seeing valuations start to get more stretched. So you start looking at a lot of the staples names, even Walmart, they're at 17 times earnings, really, and can they keep growing at that pace to support that valuation? So I think there's concern on the valuation side as well as this sustaining those earnings that they've had.
Liz Ann, Anthony mentioned about one of the stories this week was the idea that we may be back in a rate rising cycle again. Maybe, because, you know, these guys walk it, they talk it, and then they take it back. Financials had a pretty decent week on a relative basis. Should people be buying financials now?
So we actually have an outperform rating on financials. We have liked them. There's a little bit of a wrinkle in the near term because S&P is going to pull out the REITs into its own GICS sector. It'll be the 11th sector. And that has been where a lot of the yield is. So I think some of the money that has gone into financials, it was yield chasing money, maybe doing it for the yield embedded in the REITs, and once that's pulled out. But that may actually give you an opportunity because although we do think the Fed will move again this year, and we are, I guess, therefore officially in a rate rising cycle, it's going to be of the very, very slow variety. But we think valuations have become compelling enough, and certainly the whole sector has been kind of thrown out, save for that yield play. So we're sticking with our outperform.
Liz Ann, does the market care who the next president is?
At this point, no. I think the let's just call it the unique aspects to this election and leave it at that, I think has been a volatility factor and will continue to be. You know, you talked earlier about gridlock generally being a good thing, but I think that really goes back to an era where you had counterpoints and you had that balance, but there was also reaching across the aisle to get things done. The get nothing done, I'm not sure is a positive for the market.
The market cares, Kevin, about the next president?
I think the market cares about certainty and uncertainty. So I think right now you're starting to see it's being priced into the election that Hillary Clinton is going to get elected.